Welcome to The Explainer. Today, we're going to dive into a really powerful psychological trap, one that gets nearly every investor, and often we don't even realize it's happening. The core idea? It's simple, but it's really profound. It's so much better to be approximately correct than to be perfectly, precisely wrong.
To really get our heads around this, let's start with a story. Picture this. You're in a dinosaur museum, standing next to this massive T-Rex skeleton. A tourist walks up to the guide and asks a pretty simple question. How old is this?
The guide, with total confidence, gives this incredibly specific answer. Now, wait a second. That "and 5 years" part, that sounds a little weird, doesn't it? It's so precise, it's almost suspicious.
So of course the tourist asks, how on earth could you know that? And the guide explains his logic. See, 5 years ago, an expert told him the skeleton was 100 million years old. So he just added the 5 years that had passed since then. Simple math, right?
And that right there, that little story, perfectly nails the difference between precision and accuracy. The expert's answer, about 100 million years, was accurate. It was a correct but kind of fuzzy range. The guide's answer was incredibly precise, but all that extra precision added zero actual value. In fact, it was pretty misleading.
So, this desire for exact numbers, it's not just some funny museum story. It's a really deep human trait. And in the world of investing, this seduction of precision can be, well, it can be incredibly dangerous.
You know who summed this up perfectly? The legendary economist John Maynard Keynes. This single sentence is a guiding principle that honestly could save investors from a world of trouble.
The investing icon Charlie Munger, he gave this bias a brilliant name: physics envy. It's that craving we have to make messy, complicated systems like the economy fit into these neat, clean formulas just like you'd find in a physics textbook. But the hard truth? They just don't.
At its core, our brains are just hardwired to hate uncertainty. Psychologists call this ambiguity aversion. We are so uncomfortable with the honest fuzziness of "I don't know" that we will grab onto any precise number, even a totally wrong one, just to get that feeling of certainty.
Okay, so let's see how this precision trap actually plays out in the real world of investing. This is where the theory gets very real, and let's be honest, very costly.
Let's take the very popular discounted cash flow model, or DCF. It's a method for trying to figure out a company's value today based on how much money people think it's going to make in the future. So, investors build these complex spreadsheets and they plug in dozens of assumptions about growth, margins, interest rates, the whole shebang. And after all that work, the model spits out a number. And look at that. It seems so official, so exact, right down to the penny. It feels like you've just discovered some fundamental truth of the universe.
But here's the trap. That precision is a complete and total illusion. Because if your initial guess about revenue growth is off by just a tiny, totally plausible amount, say 2%, the entire beautifully precise calculation just becomes worthless.
There's a popular saying in the investing community that just nails this. These detailed spreadsheets create a really dangerous false confidence, making us believe our fictional forecasts are actual facts.
And we see this trap everywhere in analyst reports too. You'll see these incredibly specific price targets, as if someone has a crystal ball that can predict a stock's value down to the exact rupee.
These specific targets are so powerful because they trigger our anchoring bias. Once we see a number like 734 rupees, our brain just latches onto it. It becomes an anchor, and all of our future judgments about that stock's real value get skewed by that initial and often totally arbitrary figure.
Now you might be thinking, okay, I get it for picking stocks, but I'm safe because I just invest in mutual funds. Well, not so fast. The trap of false precision is waiting for you there too. How often have you seen investors agonize over charts just like this? They'll spend hours comparing funds, absolutely convinced that the tiny decimal point difference between Fund A and Fund B holds the secret to future success.
And here's the huge disconnect. We get obsessed with the false precision of tiny differences in past returns or expense ratios, but what actually drives long-term results are the big, fuzzy, roughly right things: your overall asset allocation, and maybe most importantly, how you behave when the market inevitably panics.
So the takeaway here is simple but really profound. It doesn't matter if you're picking individual stocks or choosing mutual funds, whether you're driving a sports car or a minivan. These psychological biases are always riding shotgun. So if chasing precision is a trap, what's the alternative? How do we actually apply this idea of being roughly right to become smarter investors?
Well, it starts with 3 of the most powerful words in investing. I don't know. Real strength isn't pretending to have all the answers, it's the humility to acknowledge the deep uncertainty of the future.
So, what does this better approach actually look like? You accept that the future is fuzzy. Instead of one precise value from a model, you think in ranges of possibilities. You always build in a margin of safety, a cushion for when you are inevitably wrong. And you just learn to get comfortable with not knowing.
And you know what? Here's the liberating part. Once you stop fighting uncertainty and start embracing it, your entire perspective shifts. You stop trying to predict the future and you start trying to prepare for a range of possible futures. Uncertainty isn't a problem to be solved, it is the game.
So we'll leave you with this one last thought. In a world that is obsessed with finding the perfect, precise answer, maybe the greatest advantage you can develop is the discipline to be simply and wisely roughly right. Perhaps that is the most precise edge of all.